Hello and welcome back to Dukascopy TV. I'm Natalie MacDonald, bringing you another exclusive interview. Now, tapering is the word on everyone's lips, and here to look a little bit more at central bank exit strategy is Charles Wyplosz. Charles, thank you so much for coming in today and joining us. Now, if we consider central bank exit strategy, is this about going back to pre-crisis method or about a new chapter of economic policy?
Well, one thing we're talking about is about reducing the size of central banks that have grown enormously in terms of their assets. So that's one part of the story. It doesn't have to go back to pre-crisis levels, but it has lots of liquidity have to be reabsorbed. The other thing we're talking about is all the new things that central banks have discovered they have to do that relate to financial stability and had been thoroughly forgotten in the years up to the crisis. So central banks now have a much wider mandate than they had before and probably than they want to, but they'll have to deal with that.
Now, if we look, for example, at the US Federal Reserve, obviously the scaling back of their assets is a big headline at present. Now, historically, a US retreat from monetary stimulus hits specific areas such as automobiles, housing. Is there a way of exiting neutrally? Could almost this long drawn out move towards tapering in fact allow for a more neutral exit for the US central bank?
Well, that's one of the classic drawbacks of monetary policies, that it works through particular sectors. So on the way up, when the central bank is easing up, a number of sectors benefit. On the way out, these sectors are the first to feel the pressure. That's life.
If we compare that then, say for example, with the Bank of Japan, who are continuing to pour more money into asset purchasing, they're really at two polar opposites. Now, naturally, we don't expect coordination between central banks, but given the size, for example, of Japan and the US economy, would some sort of cohesion really be beneficial for the global economy?
Well, it would be nice to have cohesion, but you'll have to explain what it should be. Japan started way later than the US to do quantitative easing, or they had done it in the 90s and they restarted right now. The Japanese are about 3 years behind the US, so they will probably exit a number of years, 2, 3, 4 years after the US, and there's nothing else we can do about that. Now, this will have repercussions on the exchange rate. The first that exits will probably see its exchange rate appreciate, and the other one will see depreciate. But there's nothing we can do about that. In fact, more importantly than that, the exchange rate is powerfully reinforcing monetary policy. So if the US is the first to exit, which is going to happen, the dollar will appreciate strongly vis-à-vis the Japanese yen, which will have a further slowing down effect on the US economy, which is exactly what the Fed wants to do, and it will have a further expansionary effect on the Japanese economy, which is exactly what the Bank of Japan wants to achieve. So these effects, these international effects, they all go in the right direction for the two countries. Now, how about the others, the innocent bystanders? Well, they are innocent and they take a hit, and there's nothing really you can do when you're in this international globalized economy. You're part of it.
So who, in your view, is doing it right, or perhaps has the potential to do it right? And similarly, who do you foresee having a bit more of a bumpy exit?
Well, first, we don't know who's going to do it right because nobody has started yet. Second, this is a historical experiment. It's never been done before. So it's likely to be bumpy because although we are thinking very hard about all the aspects of the experiment, we can't avoid forgetting something or making a mistake. So the first one that goes is likely to find a bumpier road because it will be an experiment. Now, as you just noticed, the exchange rate is going to be an important part of the story. Countries that are very sensitive to the exchange rate are going to see a bumpier road, as you said, because the exchange rates tend to move too much. and we don't even know what we expect, how much we expect the exchange rate to move, again, because we've not done that before. Now, a big, reasonably closed economy like the US is not going to care too much about the exchange rate. Actually, the rest of the world is going to care about their exchange rate. But if you take a smaller countries, they will be more sensitive. And here Japan is reasonably closed, but the UK, that has done a lot of central bank balance sheet expansion, and will have to scale back. The UK is a very open economy, very integrated to the European Union and to the US. So they may have nasty surprises along the way because the pound may move too much in one direction or another. But the truth is, we just don't know.
Charles, thank you so much. Really fascinating topic to get your insight.
You're welcome.
Thank you. That's all we've got time for right now, but we'll be back shortly with more exclusive interviews for you, so don't go away. Goodbye for now.